Hey everyone, hope you're doing well. And this is the Deep Dive. My name is Drew Creekmer, and I am here with John Creekmer, our founder and senior wealth advisor. And today we are going to spend some pretty serious time going over what has happened in the last 2 weeks in the global financial system. We're going to break down what's happened with Silicon Valley Bank, and we're going to talk a little bit about what's being done at some larger national, multinational banks as well, and how it relates to you and making sure that your financial plan is in the right place for what's going on in the world around us. But before we do that, John, how you doing today?
I'll tell you, I'm doing good, Drew. And it's interesting when things are always happening in the world, and there's always stuff going on, and a lot of times we don't understand the risk that's happened under the surface of things, and oftentimes there's risks that we're not aware of. And
Right.
I'll be happy to say that we actually had no money at Sovereign or Silicon Valley Bank, and no money at Sovereign. And we do pay attention as far as with lending practices and also with deposit and ranking with a little more detail on that later on. But also inside portfolios, it's so critical to make sure that we understand the risk involved in portfolios, and that we have a proper assessment. And I think a lot of people just over time don't really understand the risk involved in their portfolios until all of a sudden an event happens. And so whether you're talking about your personal health or whether you're talking about your portfolio, it always makes sense to recognize that there's danger under the surface that's always lurking, and it makes sense to make sure you're always aware of where those risks are at.
Yeah, absolutely. Absolutely. So we'll dive into that in a second. Before we do that, though, one to remind everyone, we're in one of everyone's least favorite times of year, it's tax season. We have about exactly a month until taxes are due. What that means for you is you have a few more weeks where you can make your 2022 IRA or Roth IRA contributions. And so we would strongly encourage you to do that. If you want to make that contribution, reach out to our office, and please do so no later than April 13th, just because there's so many people who are trying to get that last minute contribution done. Things can take a little bit longer over at our custodians where your accounts are at. So we would encourage you, reach out here in the next couple of weeks. So, all right, John, let's dive into it. Let's start here and talk about what happened at Silicon Valley Bank. What were the two or three critical errors that they made that led to the second largest bank collapse in history here in the United States of what was at the time the 16th largest bank by deposits? And so what kind of went on behind the scenes that led to them going out of business?
Drew, have you seen the meme with The Simpsons of Bart having predicted the Silicon
Yep.
Valley Bank failure? So just so we know, that actually did not happen with Silicon Valley Bank. Somebody superimposed the name Silicon Valley Bank on that. So if you look up Simpsons Silicon Valley Bank, you'll find the meme. And so let's kind of get a little background first as far as on banks and what they do whenever you make a deposit. So let's say you go into a bank and you make a deposit and you move $100,000 of your money into the bank, and you put it on deposit. There was a checking account, money market account, a CD. They don't hold $100,000 in cash and in bills in the bank vault for you, waiting for you to make a withdrawal. And if you need a history lesson on that, make sure you watch It's a Wonderful Life. And that one, when a whole bank fell down, it was explained very clearly that your money is not here. It's in Bill's house. It's in Fred's house.
Yeah.
In other words, what the bank does is your deposit goes in. They hold a certain percentage in cash, and that usually is mostly on deposit with the Federal Reserve to be accessed for withdrawals. Then they take a certain percentage and they lend it out to individuals in the form of loans, or in businesses in the form of loans for a house loan or a car loan or a personal loan or even for a business loan, to take care of whatever the business will happen to need. And then a certain percentage gets invested into U.S. government bonds, bills, notes, and also agencies of the federal government. And so let's just say that in simple terms, it's something like 10% of the deposit is actually held in cash, either they're at the bank or at the Federal Reserve. 45% is loaned out in the form of loans, and then 45% is in the form of U.S. government bonds, notes, bills, or a U.S. agency. Now, those percentages can change and based upon the really the parameters of the state, if they're a state charter, or the federal government as far as what percentage was in each category. When it comes to Silicon Valley Bank, what happened was they had a large number of their depositors were small businesses, or else they were businesses funded either through private equity or venture capital, and they received a large amount of money to fund their business, and those dollars went on deposit at the bank, and the dollars that were deposited exceeded the $250,000 limit that's protected by the FDIC and Insurance Corporation. Drew, I'm not sure, I don't remember the exact number. It was over 81%. Does that sound right?
Yeah.
Yep. Of the deposits exceeded that dollar amount. And so once they receive those deposits, the bank then goes, they should do an analysis to say when those dollars may be demanded or used by the depositor. And based upon aging summaries, they're able to have a pretty close, accurate estimate for when they need to have money available. Then they set up the terms of the loans and then the terms of the treasuries they buy based upon when they're going to need the money. With the U.S. government since 2008, keeping interest rates artificially low and at record lows for so long, the interest that they earned as far as on their treasuries was very low, historically low. So what Silicon Valley Bank did was they actually took and bought long-term, long maturity bonds in order to increase the yield that the bank was receiving into the bank. Then all of a sudden, over the last 10 months, the Federal Reserve has increased interest rates faster than at any time in the history of the U.S. economy. And they also increased interest rates not just faster, but also at a higher percentage increase over that period of time they ever experienced. So we had an outlier event with interest rates going up. And as everybody knows that listens to us talk, whenever interest rates go up, the value of bonds goes down in your portfolio. And so all of a sudden then the bank needed to liquidate those because people were wanting to pull their money out to fund their business. It was cheaper to use cash than to borrow money. And so they had a demand or a withdrawal request for a large amount of money. So the bank had to sell those bonds at a loss. And I believe they actually had to sell at a loss of $1.8 billion as far as on the accounts. And so because of that, it caused a run on the bank to where there's not really enough money to send out to the individuals. And so ultimately, that's what happened with Silicon Valley Bank.
Yeah. And so when we summarize it, essentially it's the bank made a couple of poor assumptions that what's happened in the past with low interest rates would continue. And then they did a very poor job managing their risk for having such a concentrated depositor base. Now, John, over the last weekend, the U.S. Treasury, FDIC, and Federal Reserve began trying to contain what could have become a systemic issue with regional banks having people pull their money out and sending those to the large, massive banks like JP Morgan or Bank of America. And so what were the actions that they took, one, to ensure that all depositors at Silicon Valley Bank would receive their funds back, but also to provide some programs to help ensure that we don't have other regional banks experience the same issue with their bond portfolio?
Yeah, so they really did a couple of things. First of all, they said regardless of size of the deposit, that every single depositor was going to be covered by the full faith and credit of the FDIC. And so every deposit is insured, even those with over $250,000 as far as inside their deposit base. And so they provided a backstop to make sure that everyone is covered there. The second thing they did is they opened up a window of liquidity, and so a lending window for the banks to be able to access additional dollars, so they would not have to sell or liquidate off any intermediate or longer term bonds at a loss, so that they have access to cash to be able to make sure they have the dollars to handle any deposit or withdrawal needs, especially. And in doing so, they actually provided a tremendous amount of liquidity into the system. And so this really comes up to a liquidity question that we see as far as in the banking side, that also those play into personal financial decisions of making sure you always have appropriate levels of liquidity inside your entire portfolio. But that's what the federal government did through the different various agencies or departments.
Yeah. And so that did go a decent way to calming some nerves over the weekend. But then earlier this week, we had a large amount of people concerned about one of the 9 largest banks in the world. It's considered to be a critical bank founded back in the 1850s over in Switzerland, and that's Credit Suisse. And for those of you who may not be aware, Credit Suisse over the last 4 or 5 years has just had a litany of issues, terrible management, scandals, and large fines. And so they have been struggling for the last 4 or 5 years, and there have been concerns about that bank. That said, in the fall of last year, they began really rapidly trying to reduce the risk at the bank by selling off risky loans and trying to raise more cash. And so what happened earlier this week is one of their largest investors, which is a bank over in Saudi Arabia, said that they were not going to be providing any more liquidity by investing in the bank because they could not own more than 10% of a foreign bank. And then around the same time, the CEO of Credit Suisse did a very poor job answering a question about the bank's liquidity base. And so those two things combined with Silicon Valley banks failing over here in the U.S. led to what was a larger concern that one of the 9 largest banks in the world would possibly go under. And so, John, what happened? What did the Swiss National Bank do here? And how big of a risk is this really at this moment in time?
Right now, Swiss National Bank stepped in, and that's very, very similar to our Federal Reserve, if you will, or our U.S. Treasury, kind of a combination of the two. But they stepped in and provided liquidity, billions and billions of dollars of liquidity over to Credit Suisse. In addition, they guarantee withdrawals and deposits from the institution. So in essence, they came in and put a huge backstop behind Credit Suisse to give a little bit more stability with the CEO and with the management structure with Credit Suisse as they continue to navigate, and to give them more time to actually turn the ship around as far as in the management decisions they have within that organization. This really first came into light about 2 years ago. And at that time, Credit Suisse went walking through with the new CEO a whole restructuring plan that was bought into by additional outside investors and also governments. And so they have been navigating and making, I'm going to say, better decisions in the internal management structure and decisions that they have, and also with their corporate governance. And then the decisions last week by the Swiss National Bank really provided a lot of additional confidence and security there. That's not to say that it is totally out of the woods yet with Credit Suisse, but what that does speak to is actually there being more structure and foundational support with recognizing how important this institution is.
Yeah. And so, John, when we just zoom out and look big picture, we've talked about bonds being such an important part of these banks' portfolios. And so we all have talked about quite a bit here on this show about how in order to bring down inflation, interest rates have to be raised and the monetary supply needs to be made much smaller than what it currently is. And so a big question that a lot of people have is the Federal Reserve and other international banking governing bodies, are they going to continue raising interest rates, or are they not going to continue? What should we watch for in terms of signals about, hey, is there a bigger systemic issue going on with banks, or is it still all full speed ahead to try to bring down inflation?
I think that one of the old rules of thumb is that the Federal Reserve will continue raising interest rates until they break something. And typically that breaking of something is referring to inflation. But it could refer to other underlying situations, such as the broad-based economy, which would put the economy into a recession. Or in this case here, they're starting to actually break the banking system. But now they're having to come back and provide additional support. And so the reality is they created a huge problem with the influx of a lot of additional cash. We were sitting at the highest level of cash in recorded history as far as dollars that were printed over the last 3 years. And they simply need to go and remove those dollars from the system. But it's not as simple as just removing the dollars from the system. So we have 2 levers that can be played with. One is simply interest rates, and the other is the removal of excess cash out of the economy, in which case it goes on the balance sheet of the Federal Reserve. Well, they're continuing to do that at a $90 to $100 billion a clip a month as far as removing dollars, and that will continue on.
Yeah, absolutely. So reach out to your advisor, schedule a 15-minute strategy call, and walk through all the potential tools that are out there. And also, John, I think it's important to point out that inside of investment accounts, we are sitting pretty conservatively right now. So even amidst all the recent volatility, we're seeing portfolios hold up very well compared to the broader indices, which has been a very encouraging thing. So thanks for your time, guys. If you have any questions for us, absolutely reach out. We'll be more than happy to dive into all the details about what's been going on in the banking system, and we can always find any solutions that are out there to make sure that your cash is working hard for you. So have a good one, guys. We'll talk to you later.